Folks, welcome to the Contrarian Trader. This is Robert Desmond. It is Saturday, November the 26th, 2011. I hope everybody had a great Thanksgiving with their families. I had a great one. It's great to be back to work. So let's begin with the topics that we're going to cover today. The first is going to be the economic data that was released last week. Secondly, Germany, not the EU, but Germany, because they are the linchpin in solving the crisis over in Europe. Thirdly, the bank stress tests that were announced for the United States last week. Fourthly, we want to discuss our trades from last week. And lastly, let's go into the charts of the stocks that we're looking to trade in the coming week and next week and the following week. Let's put it that way, because we're not exactly sure where we're going to head right now. So let's get to the economic data first. Last week you had existing home sales that were released. They came in slightly better than expected, which is good. It's great. GDP. This is not a shock here. I don't believe the market sold off on this. This was not a shock. I am not a Harvard grad. I did not expect us to grow at 2.5% when you have Europe slowing down and China slowing down. This is no shock here. The initial jobless claims came in slightly worse than expected, but they were below the 400,000 mark, which is a psychological level. Durable goods orders came in worse than expected. I had hoped to see a beat on this number because that could have moved the market. We didn't get it. Michigan Sentiment Survey came in about par. The only real surprise last week was there was a huge draw in crude inventories last week. So, although we had some market-moving indicators last week, there were no true surprises with the exception of crude inventories, which technically is bullish. Because if you're drawing down on your crude inventories, you're using it for something. You're not dumping it into the ocean, God forbid. Let's move on to Germany. This is off of Bloomberg. You had the German bond auctions last week, which came in far worse than was expected. That is some scary stuff for Germany. Now, the Germans cannot afford to have the EU dissolve, because if they did, their markets are so efficient in Germany that their mark, the Deutsche Mark, which they would revert back to, would be extremely high valued, so high valued, in fact, that it would be prohibitive to export their goods. So the Germans cannot afford to have the EU dissolve. So although these periphery states don't appear to have much leverage, they do, especially France, which is now having the bond vigilantes knocking their door as well. So I do not believe that the EU is going to dissolve. I believe that if the EU does survive, it will be dilutive to the euro, therefore a positive for the U.S. dollar, which of late, that positive or bullish action on the U.S. dollar is negative for the U.S. stock markets. And as I always say, as sick and perverse as that is. And the reason why that is due to the fact that you have a consumer that is so over-leveraged here in the United States that companies domiciled here depend upon the foreign markets for more and more of their earnings. So it is what it is. As much as I can't stand that saying, unfortunately, that stronger U.S. dollar is negative for the stock market. Let's move ahead to the bank stress test. I think that the bank stress test, the contrarian opinion that I have, and I was shocked the night that it was announced. I was shocked to hear the opinions out of the folks on Fast Money, and their attitude was, understandably so, skeptical of what the Fed was trying to do. I viewed it as proactive, finally proactive. Why is that? I view it as proactive because suppose the Germans and the Europeans do not get their house in order in time for the elections. You could see the stock market trading down to the 2009 lows. Obama cannot afford to make that have that happen. Now, if they have these stress tests and they factor in a default over in Europe, and it's concluded that the U.S. banks can survive a faltering EU and a collapse of one of their major banks, Deutsche Bank in particular. If they can get this issue in the rearview mirror, even though the EU issue is not resolved, yet the markets understand that the banks can afford, they can accept that stress on their balance sheets and on their businesses and can survive, well, then the EU is put to the back burner then, isn't it? Because if it does collapse, well, then we know that the banks here in the United States can survive. They can raise capital. I think it's ingenious that the Federal Reserve is making this happen now. Smart move. Kudos to Ben Bernanke, who I've been critical of. Smart move, Ben. Let's move on to the markets. I'm going to go into this a lot further detail with my members in the Contrarian Trader, the week ahead commentary, which I'll be sending out to members only on Sunday. But you need to watch these charts. This is a chart of the US dollar with an overlay of the S&P 500. Note how you have the US dollar breaking out, the stock market breaking down. And I'm going to give my opinions about where I believe the US dollar is headed in the coming week and weeks. And it will have an impact on the overall US stock market. The VIX, I'll be going into this in detail as well. This chart here speaks volumes to me about where we're going to be headed in the near term. But I'm not going to waste your time right now going into this. I'm going to get into the stocks that we're looking at, but I will be going into this in detail with my members tomorrow. So if you want to take a look at that week ahead commentary, sign up for the 14-day free trial offer, and I'll get that out to you. It'll be included in the email list. The Dow Jones Industrial Average. I'm going to give my opinions upon where I believe the Dow Jones is heading in the near term. And in short, folks, it doesn't look good. This is a weekly chart of the Dow Jones Industrial Average. Can that all change in the remaining days of November? There's a possibility, but it's not probable. And again, I'll be going into this chart as well. And the analysis of these charts here, US dollar, VIX, Dow Jones Industrials, pretty much gives you what you'll need to see. And I'll go into the banking sector and I'll go into the semiconductor sector as well to develop a thesis upon where we're going to head next. And we'll factor in the euro issues as well into where I believe the markets are going to head. Okay, Diamond Foods. Diamond Foods, we've traded a number of times and posted it on the blog in the past few weeks. And we're going to look to get long of Diamond Foods once again. And yes, they have some serious issues with their books. They had a suicide by one of their auditors last week. And it's reflected in the stock, folks. It's reflected here. For a short-term trade anyway. This is not an investment by any stretch of the imagination. But as a short-term trade, it is still a viable trade. And last week, we traded this twice on the 23rd. Both were profitable trades. The first one in the morning, we're using a 1-minute chart. We traded it off of that 1-minute chart. We scalped about 75 cents per share. We got out. We got into it later on in the afternoon. I wasn't as happy with that entry point. The stock sold off. The second I pulled that trigger on that buy order, it sold off. It did rally into the close, and we got out of that position with a very small profit. When you consider the risk to reward on that trade, the second trade of the day wasn't worth it. So in hindsight, I would not make that trade again. The morning trade, I would. But that's where discipline counts with stocks like this. Now we're looking at Diamond Foods, again, threatening to break down to new intraday lows. Now, you could see that on Friday it was a half a day, folks, and yet volume came in higher than the daily average, which is not good. So the trend on volume to the downside remains high. Stokes are looking great. When this stock snaps back, when we get that counter trend rally, there's a huge short interest on this stock. So it's going to take a couple of days to cover their positions. So we anticipate a big snapback rally and some nice profits. And I'll be sending out alerts on all these trades. If and when we do get involved with them, I will send out trade alerts to my members when we get in, when we add more to a position, and when we get out. You can see money flow is beginning to, the extraction of money out of the stock is beginning to lighten, and you're beginning to see a little bit of money flow into Diamond Food. KSWS. This is one that we had on a watch list a couple of weeks ago, and it disappeared, and I went back to take a look at it. And you can see it was on our watch list because the RSI was so deeply oversold. And it's not as much as it was when I liked it. However, I did keep an eye on it. I do like the fact that it did have this nice doji formation on Thursday. Volume has really dropped off a cliff, so the selling volume is really dissipated. The reason why you would not have wanted to got involved with this stock earlier, look at this topping tail here. It attempted to rally. The previous attempts to rally above the $3 per share level have failed. This was a failure, a huge failure. So if anything, if we do get involved with this stock, we're going to rally it up to the $3 per share level, get out at that level. Stokes are looking good. They're curling up. So I like KSWS. Cheap stock. So we may just look to trade this stock. Next one. I don't know whether it's G3 in Roman numerals or GIII. But we've added this one to our watch list. I think there's some further downside on the week ahead commentary for members. We're going to take a look at the weekly and the intraday charts on many of these stocks I'm going to go into. But right now for the blog, I'm just going to go into the daily charts. You can see how volume dropped off some. The slow Stokes, although they are deeply oversold, I'm not that impressed by them yet. I'd want to see some further pullback on the slow Stokes. MACD is looking good. On the histogram, not on the lines. I don't pay attention to these lines that much. The lines they're not a leading indicator. The histogram is more of a leading indicator. Tempur-Pedic. This is an IBD, Investors Business Daily darling. Some time ago, you could see how it broke down. And I love to take a look at these and say, when would I have gotten short of Tempur-Pedic? And one way to have done that would have been to, watch the attempts to rally back. You had this attempt to break out higher above the 71.70 level. You had this topping tail here. Now, that's not necessarily a signal to go short, although you could have opened up a small position. When you got this pullback, you want to wait for a counter trend rally. And as I always tell my members, the test is always at the top. If you see a failure to break out higher and then the stock breaks down, that's your cue. You get short. That's the market telling you the rally's over. Another way to have taken a look at this stock to get short of is you wait for that pullback. Suppose you didn't get involved. You wanted to wait for a double bottom formation, which you had here, a rally. Will it break above previous highs at 74.81? You draw your trend line across, and no, you didn't get it. It topped out at 72. It began to break down. Same rules apply to here. You get a breakdown below previous support. You do the same thing here. You draw your trend line below here. And once it breaks down below there, it's a short all day long. The market's telling you that the stock is broken, and this stock is broken. With that being said, we're going to watch it for a counter trend rally. Why don't we want to do it on Monday morning? Look at the volume. The volume is very, very high to the downside. There's more selling that's going to come into the stock. Stokes, yes, below 20 and below 30, and all these books that tell you to buy a stock when it's below 20 and below 30 on the stochastics. They'll have you in the poorhouse if you listen to them. You need to use your indicators in collaboration with your volume bars, with the candlesticks. This is not an indicator in and of itself. The MACD histogram is telling you stay away from the stock right now. The trend is down. So this is just a watch right now. And I like this stock. Open table. I don't just like this stock. I love this stock. I use this stock. I use it all the time. I think it's a great, great company. Keep in mind, though, you got a PE of 50 on this sucker. So if this market gives way, the retail sector, of which Open Table is a part of, is it a technology stock? Sure it is. But it's also, it hinges on the retail sector. If you don't have people going out and eating in restaurants, they're not going to use Open Table. So you need to keep an eye on the retailers. Once you have gotten short of this stock, this is a much easier one than Tempur-Pedic. Here's your rally back in April to 118.66 as your high. It pulled back. Look at this long a long candlestick formation. Found support, rallied, could not break above previous highs. Again, the test is always at the top. 115.07 was your high. Here's you draw your line here at the 107 level. Once it broke down below there, it was a short all day long. And sure enough, look at the mess that this stock has been in. So I like Open Table. I've wanted to get long of this stock for quite some time, and it's coming within that range of where we want to get long of it. It's not an extreme oversold stock. That's when I want a piece of it. Take a look at these volume bars. The down volume bars are dropping off. So I like the stock. The RSI is only 23.73. That doesn't excite me. Look, the default on the stock chart is 30 for an oversold stock. Again, if you use this as a rule, you'll go broke. I like to see an RSI below 20 in the teens. RIMM. I get a lot of members that ask me to keep an eye on this stock, and I do it. And I was asked back here, is the stock a buy? And I said, oh, actually back here, no. I said, no. You're in a trading channel. You want to get long of the stock at the bottom of that trading channel. I like RIMM. The only reason why you had this rally here is because you had Leo Cooperman come on in and say, or Lee Cooperman come on in and say, I'm buying up the stock. And more than likely, Leon Cooperman is a very smart man, is still buying up the stock, but at lower levels. We don't want to get involved with this one, not just yet. I will be sending out an alert when we do. More than likely, we will. Lee Cooperman is a whale. He's a big-time whale. I like the guy, but I can imagine where he's really going to start buying up the stock, and I'll be sending out an alert to members when we decide to join in with Lee. Abercrombie & Fitch, another retailer. Again, when was your signal to get out of this stock? Sometimes you have breakout point failures. You have your stock that rallied. It did, in fact, make a new high. But if you use your indicators, which I use all the time, you use your RSI. Although the stock was setting up to break out to new highs, and it did, the RSI failed to confirm the move higher. Is that a reason to sell the stock? No. But it's a reason to hold the stock suspect. Go back to my previous videos on Apple. I had been watching Apple for months, and you saw a negative divergence. The stock was heading up 26%, yet the RSI was pulling back. That was weakness. And it was only when Steve Jobs passed away that we knew that, you know what, it was time to short the stock. Now, you don't have that visionary at this company, although it's a very fine retailer. All you needed to see was the fact that you had this divergence here, a failure to continue this breakout higher. Where you want to put your short sale order? Right here. Right here. Once it broke down below 62.04, you knew that the stock was broken. Although you had your counter trend here, all you needed to do was put your stop loss above the 77.72 level. And I'm not saying you buy or you short your entire intended position at the 62.04 level. No. You short a little bit. And if you get stopped out here, you're not that hurt. And as the stock proceeded to rally up here, you may want to nibble a little bit more. And once you saw that it was going to fail at 77.19, you really begin to add to your short position. You need to build that position. So that's how you want to short this stock. This is a weekly chart. Now let's get to the daily chart of Abercrombie. Now Abercrombie on a daily chart is looking good. However, on the candlesticks it's looking good. You're seeing these nice doji formations, bottoming tails here. The down volume is dropping off considerably. MACD is looking good. Money flow. I may be involved with this stock a little bit sooner than expected. The only thing that's not confirming the stock's extreme oversold qualification is the fact that it is still trading a relatively high RSI for me. I like to see that RSI below 20. So we'll keep an eye on this one. We may get involved with it sooner than expected, but I would like to see that RSI below 20. That's my only caveat, and I'll get into this a little bit further with members tomorrow. Okay, when you're trading these stocks, and this is the reason why I was hedging a little bit on the A&F trade, is you need to watch for the action of the sector. And all the stocks I've covered thus far as extreme oversold trades or oversold trades are retailers. Their exposure is to the retail sector. So what do you want to do before you get involved with these is you want to take a look at the overall sector, and it's not good. The retail sector is not looking good. It's trading below support. It is trading now below its 200-day moving average. Volume is dropping off some. Slow Stokes, they're not that sexy yet. Selling pressure is beginning to lighten up, but the fact that it's broken below its 200-day moving average is significant. Now, if we wake up on Monday and you see a pop higher above the 200-day moving average, the story changes. Then we can get a little bit more risky with our trades. Until we see strength in the RTH, we need to stand by our disciplines of when we're going to trade these retail stocks. And Abercrombie & Fitch has not met that criteria yet. If we see a pop-up higher above this 200-day moving average on Monday morning, that could all change. We can get a little bit more nimble in our trading. Let's move on. NTLSD, Natellos Holdings Corp. It's a communication services company. RSI is not quite there yet, 2032 on the RSI. The stock is heading lower at this point in time. The only thing that's saving the stock from me really pounding it and getting short is a down volume is really giving way. These topping tails here tell me that there's resistance at the $19 per share level. So even if we see a gap up and we see a failure to close above 19, I want to stay away from the stock. We want to see it get cheaper. The stock was healing. You saw the MACD histogram. The selling pressure was declining considerably, but that all changed in the past several trading days. Williams percentage R, looking good actually. I like this Williams percentage R, extreme oversold. Let's watch. Let's hope to see some further downside in NTLSD. I can't even say the name. Okay, let's continue. L-Star Group, ELT, RSI below 20. So it's meeting our minimum qualifications. Nice action on Thursday and Friday. Friday's action in particular was pretty good. Sold off. Key reversal to the upside. Will it hold? That's the key. MACD is not meeting our criteria yet. We're going to keep an eye on this. The reason why I'm even discussing it right now with all of these is a reason why they're on the watch list, and that's because I see something positive in all of them. But each one of them has not met my qualifications for a long trade as of yet, and that includes Diamond Foods. Keegan Resources, which is a gold mining stock. Listen, folks, as goes the dollar, so goes the miners. So if the dollar continues to strengthen, then you're going to see weakness in the miners and in gold prices because they're denominated in dollars. So as goes the value of the dollar higher, so goes the value of gold lower. So right now, although I like this stock, I would like to get a piece of it. Volume is still relatively high. Got to remember, Friday was a half a day and volume was relatively high. Stokes are flattening, which is good. I think we're going to see further lower lows on Keegan, but I like it. It's only $3.50 a share. We could buy a whole bunch of stock on this and trade it for a $50 pop and do well on it. All right, the GDX. This is obviously the parent sector of Keegan Resources. It's a mining stock. The GDX is a basket of the gold miners, and you can see very, very weak. Look at this hammer formation to the downside. This is a bearish chart. It rallied in the morning on Friday. They sold it off as they did the entire market on Friday. I'm not willing to buy the GDX thus far, especially if it breaks down below, which it really already has. What did it close at? Yeah, it closed down below 55 level, closed at 54.79. So, granted, Friday's action was on light volume. Not many people came to work on Friday, and it was only a half day's trade. So you need to keep that into perspective, but I'm not willing to rationalize the fact that it closed below a key support level. So since I'm not going to rationalize, GDX is broken. It's probably going to head lower. You had the death cross. You had the 50-day moving average cross below the 200-day moving average. I think we're going to see lower prices on the GDX. So therefore, I'm going to wait for the extremes on Keegan Resources because I can afford to. Because more than likely, Keegan Resources is going to trade with the GDX. Medicis. This is a weekly chart of Medicis. If anything right now, folks, this is a short. See how it rallied? It had it. Let's backtrack. I'm getting ahead of myself. We had a rally up to the $40.42 level back in July. Corrected, fine. Found support at its 50-week moving average, rallied higher. It found resistance at the 39.52 level, pulled back, made a new higher low. This is what caused, technically it should have been a short. Could have been opening up a short position in the stock right here on this basis alone. Look at the topping tails here. Now, you had support that came in. Buyers came in at the $34.27 level, and they bid it up. Now, watch the RSI. It's not confirming these moves higher. Take a look at the volume bars, very light volume bars. So the conviction of this move higher was not great. And I'm not saying that you should have got all in short at the 39.52 level. You should have been doing it when you looked to see whether or not it was going to be able to break above the $40.42 level, which it was unable to do. It closed higher. Its highs were at the $40.10 level. That's when you should have been adding in earnest to your short positions. And the minute it broke below 34.27 level, that was your new lower high and your new lower high. Then you should have been all in short. This is going lower. MRX is going lower. Where to close? Closed at 29.93. That broke below its $30.41 level. It's confirming the move lower. So you do not want to be adding to the stock as an investment yet. It's got further downside. I believe that it did come up. Yes, it did. Came up as an oversold trade of which we may look to take a piece of for a couple of days trade only. I think that we're going to see the stock rally, then roll back over and head lower. Look at the 50-day moving average crossing, hooking down. It's going to threaten to take out the 200-day moving average. We may see a rally in the stock before this 50-day crosses below the 200-day moving average. The slow Stokes, I'm not going to get involved with this unless I see this down in the team. I'm sorry, scratch. I am not going to, the RSI. I am not going to get involved with this trade unless I see the RSI down in the teens. So let's keep an eye on it. If we see a rapid sell-off on MRX, we may get a piece of it, but I'm not going to want to hold on to this very long because this death cross is coming down. 50-day negatively diverging below the 200-day moving average. You don't want to be a piece of that stock to the long side. And that's it, folks. If you want to become a member of the Contrarian Trader, you want to see what commentary I'm going to be putting out to members tomorrow, my analysis of the overall stock market and where we're probably going to be headed, please sign up for the 14-day free trial offer, and I will add you to the email list. You'll get that commentary tomorrow. For everybody else, enjoy the remainder of your weekend. Great, thanks for visiting the site. And for those folks that are looking to get added to the email list for when I add to our blog, please go to the right side of the page, enter your email address. Just remember to go to your email and click approve so that we'll be able to send you those emails. I do not spam. I do not sell your email information, which is why I don't even ask for your first name or last name on the email. I do not do that. So please sign up for the 14-day free trial off if you want to get our stock alerts, week ahead commentary, and our daily commentary as well. Have a great trading week, folks. Bye-bye.